Hello, I'm Bayani Cruz from The Asset, and today I'm here with Priscilla Look, Global Head for Index Research and Design for APAC at S&P Dow Jones. Welcome, Priscilla.
Thank you.
Okay, Priscilla, we know that smart beta strategies and factor-based investing can give us a good insight into, or can be useful for active strategies in the equities market, right? Can you just, but before we get into the technicalities, can you just explain to us briefly what is factor investing or smart beta investing?
Sure. Actually, smart beta and factor investing are kind of pretty much the same. Actually, is try to capture the market with different exposure compared to broad market index. For example, in some of the factor indices, they try to capture different factors like value, quality, momentum. In a way to capture that, the index might create with different stock selection, different weight of weighting, so that it capture the factor with different characteristics. For example, up and down market, they may have different performance, they have different sector exposure, and they have different factor exposure. But most of the time, people use it to capture the factor risk premium in a way to improve return over the long term.
And how have factors reacted to differing market sentiments, like bearish markets or bullish markets?
Actually, in our research, we try to look at how factors perform differently in different investor sentiments. Because when investors, they have different sentiment, they tend to reward and punish stock with different factor characteristics. For example, like low volatility and dividend stocks, they tend to perform better when investors felt bearish because they usually feel like low vol stocks and high dividend stocks are safe havens when they feel panicked. In contrast, like value stocks, they normally more well rewarded by investors when they feel upbeat, when they feel bullish, and that's why we notice that value index or value stocks tends to do better when investors felt bullish.
And how about in different market cycles? How do factors perform? Can you just explain to us briefly your experience?
Yeah, if we look at the market trends, right, they are classically divided into like bullish trend, bearish trend, or recovery trend. So for example, in a bearish trend, we notice that low vol stocks and quality stocks, they tend to be more defensive because they also tend to have lower volatility. That's why we notice that they perform better in neutral and bearish trend than in a bullish trend. In contrast, we notice that like momentum stocks did very well in a bullish market. However, when the market is in trend reversals, for example, if they recover from the trough, they tend to suffer a lot because momentum tends to capture the benefit from price change. And that's why whenever this trend changes, they suffer a lot and they tend to underperform the market by a lot.
Oh, okay. And how about in terms of asset allocation? How do you apply, how can you apply factor-based strategies?
So for factor-based strategies, of course, people can do single factor investing, even though, as I mentioned, there is cyclicality in the performance. However, if you look at the long-term performance, like low volatility or dividends, they had excess return almost like 9% compared to the broad market without too much of excessive risk. Therefore, inclusion of this factor in the strategic portfolio may improve the overall return. And on the other hand, for some of the investors being more sophisticated, they may even do multi-factor investing or even factor rotation in their portfolio, which has become more and more popular nowadays.
Thank you, Priscilla. There you have it, ladies and gentlemen. If for more of on factor-based investing or smart beta investing, feel free to get in touch with Priscilla. Thank you very much.
Thank you.